And so finally, we come to the idea of an accounting information system. Of course, this whole course, the whole textbook is about accounting information systems. And so in this introductory chapter, we can only skim the surface. But here is an interesting idea that we can in fact think about the whole of accounting as an information system. The whole accounting function is designed to identify, collect, process, and communicate. And this really, if you think about it, is how we define the information system to begin with. So you could think of the whole accounting function as an information system that captures and records the financial effects of the firm's transactions. When we sell items, when we buy raw material, when we pay employees, those are financial transactions, and the accounting function will capture and record data that results from those transactions, and also then process that data to produce information, for instance, in the form of reports that go to management. So the entire accounting function, can be thought of as an information system. But we could go a level down and talk about particular systems, where now we are thinking implicitly here about computer-based systems. And at that level, define what we mean by an accounting information system. The definition from the book is this one that says you're talking about a specialized subsets of information systems that process financial transactions. So essentially it's saying, let's use the idea of inheritance. Whatever an information system is, an accounting information system inherits all those properties of an information system, but then it redefines some aspects of that parent from which it inherits. So yes, it deals with, it does whatever an information system does, but the key difference is that it's really focused on financial data. That's how Hall defines it. The second definition here, a system that collects, records, stores, and processes data to produce information for decision makers. It includes people, procedures, instructions, data, software, information technology infrastructure, and internal controls and security measures. One thing that I find interesting about this definition is that it does not make mention of financial data at all. And so this definition doesn't really distinguish an accounting information system from the general idea of an information system. But the definition is useful in the sense that it actually identifies some components that collectively go into constituting this thing that we call an accounting information system. It talks about people, it talks about procedures and instructions, it talks about data, software, your infrastructure. And all of these things apply whether you are talking about accounting information systems or you are talking about information systems in general. But like I said, there's no distinction here between an accounting information system and the other kinds of information systems. A definition that I lifted off Wikipedia, a system of collecting, storing, and processing financial and accounting data that are used by decision makers. So this one, like the definition from Hall, makes that distinction between IS and, for instance, your MIS, that it processes financial and accounting data. And it goes on to say that the resulting financial reports can be used internally by management or externally by other interested parties including investors, creditors, and tax authorities. So for us, the definition that we will go with, of course, is that due to our prescribed textbook, that it is an information system, and the key thing that sets it apart from other class information systems is this idea that it focuses on financial and accounting data. The definition from Wikipedia, when it says used by decision makers, that in fact is talking about that idea that your system processes data and produces information, and that information is used for a purpose. It is used to inform decision making. And yes, the information will typically come out in the form, for instance, of financial reports. So the raw transactions go in, some processing occurs, and ultimately information comes out in the form of reports that can be used, that can be consumed internally or externally. Okay, so that is the idea of an accounting system, that it processes financial transactions. We are selling goods, we are buying raw materials, we are paying our employees, perhaps we are paying our tax dues. So all of those are financial transactions that will be catered for by the accounting information system. But it also will handle some non-financial transactions as long as they are directly related to the processing of financial transactions. For instance, we buy raw materials from suppliers, the word that sometimes people use is vendors, and so sometimes we need to add new vendors or delete some existing vendor or update their address. We need that for us to be able to pay. The payment is a financial transaction, but without us knowing who we are paying, we cannot effect that financial transaction. So yes, the transaction of updating or adding a new lab vendor might be non-financial, but it is directly related. So related, and it directly affects the processing of financial transactions. So yes, that sort of data will be kept and maintained within an accounting information system. The other big class of information systems that people talk about within organizations is what is referred to as your MIS, your management information systems. In fact, people do entire degrees that are called MIS, a degree in management information systems. In fact, the BIS degree at UB, particularly the stream within the Faculty of Business, is really an MIS kind of degree. And so you can talk about MIS when you talk about the discipline, the subject that I'm studying MIS, I'm reading for an MIS degree, but we can also talk about the actual information systems that are called management information systems. And those then will be handling non-financial transactions that typically we don't expect to see in our accounting information systems. An example here is tracking customer complaints. That typically will not be in our accounting information system. And just for completeness, here are some definitions of management information systems. The first one there says a computer-based information system used for planning, control, decision-making, or problem-solving. I'm laughing because, in fact, that definition also covers your account information system. So this really is the definition that talks about an IS broadly, not necessarily some particular kind of. The second definition there, a specific category of information system. So now this is saying, okay, there's a huge set that we call information system, but now we want to narrow our focus to a subset, and that subset is intended to provide reports on organizational performance to help middle management monitor and control the business. So here you are narrowing it down in terms of what the system is intended to do, to provide reports on the performance of the organization, and also on who the target users are, middle management, as opposed to, for instance, your executives, or as opposed to the lower level. So this is about middle management. Now, you may wonder why it is important for us to distinguish between MIS and AIS, between the Management Information System and the Account Information System. Well, one key reason is that specifically for account information systems, sometimes there are legal and ethical obligations that we need to think about. And so, for instance, when we are being audited, it will be important for the auditors to know where the AIS ends and where the MIS begins, because some of the requirements that we need to think about when auditing account information systems will not necessarily apply in other information systems. So we need to know where to be able to delineate the boundaries of our account information system. And so for that reason, it is important that we are able to distinguish the MIS from the IAS. So we talked about the idea that your account information system is really about financial transactions. And so maybe let's talk a little bit about this idea of a transaction. And here is let's call it a definition from the textbook: an event that affects or is of interest to the organization and is processed by its information system as a unit of work. This idea of a unit of work is important. People often say of transactions that they are atomic. If you still remember from your standard 6 science classes, atom is really a Greek word that means indivisible. So your transaction must be indivisible. A simple example of a transaction that we can all relate to is when you move money from one account to another. Perhaps you're moving money from your current account into your savings account. So you're going to do two things. You're going to debit your current account and you're going to credit your savings account. Imagine what would happen if after debiting your current account, before crediting your savings account, there's a power failure. So the system reflects that you have in fact withdrawn money from your current account, but it does not reflect you depositing the money into your savings account. So in that case, it would mean that you have in fact lost money. The money has just disappeared. You withdrew it and then it disappeared. And to guard against that, the system must treat this entire transaction as a single unit of work. So the withdrawal and the depositing, the debiting and the crediting collectively constitute one unit of work. Either the entire thing succeeds or it fails. So if there's a power failure halfway through, then when the system is restarted, either the entire thing commits or the entire thing is rolled back. So that way, then you are protected. So a transaction has to be atomic. And the rest of it, I think we are okay with it, that it's an event that affects or is of interest to the organization. What events are we talking about? Well, it could be, if we are a supermarket, when a customer buys an item, that's a transaction. Or we are a bank, somebody is withdrawing money from their account, that's a transaction. And you can distinguish then between financial transactions and non-financial transactions. And financial transactions, you are talking about events. Remember, transactions and event. They are talking about events that are economic in nature. Excuse me. And so they affect the assets and equities of the organization. So when somebody is buying an airline ticket from us, that we would, if we are an airline, we would think of that as a financial transaction. Or when we are buying raw materials, we would think of that as a financial transaction. Or we are paying for fuel, or we are paying salaries. Those would be financial transactions. And you may then say, well, what are non-financial transactions? And here, really, you identify them by exclusion. If they are not financial, then by definition, they are non-financial. So all other events processed by the organization's information system would be non-financial. Somebody reserving, making an airline reservation. So in that case, they are not paying at that point. They're just making a reservation. So there's no exchange of money in that context. So the transaction is not financial, but we need to capture it in our information system. So this idea of a transaction is critical. I would really urge you to take the time to become comfortable, to learn and here now my train of thought is drifting, but I think you caught my drift. So let's go on, and here is a table from the book that contrasts your county information system and your management information system, but here specifically trying to show you examples of the kind of things that will go into your MIS. For the rest of this course, of course, we'll be talking about county information systems, so we will learn about that in some detail. But for the MIS, we are making these distinctions, and as we move forward, we will talk less and less about management information systems. So things like market analysis and systems and human resource management systems and so this would be the sort of things that you're thinking about when you're talking about management information systems. Okay. and another way to excuse me, to think about this dichotomy, this distinction between IS and MIS is this diagram that the broader class is IS. They are talking about information systems. Whether you're talking about accounting information systems or management information systems, you are talking about information systems. And then you can break down this huge class of information systems into two: accounting information systems and management information systems. There will be other types of information systems, but perhaps those are sufficiently different from accounting information systems for us not to worry about the confusion. So we'll just focus here on accounting information systems and management information systems. And when you go down the MIS route, the things that you expect to see there, human resource management systems, distribution systems, marketing systems. So those collectively would belong to this group that is called MIS. So for instance, when you are managing leaves and things like that, that typically would be under your MIS. And when we go down this branch now to the account information system, the broad classes would really be this: transaction processing systems, management reporting systems, and general ledger financial reporting systems. So our course is really about this branch and not about this other branch. But it is important to keep that branch in mind, because every organization will have, well, more or less every organization will have both branches, and you need to know where one ends and where the other begins. Okay, so thinking about this branch of the tree, the account information systems, about these guys, just briefly, your transaction processing system converts economic events into okay, I think I can let you read that. But a typical example that people often use of transaction processing system, think about what happens when you are buying from your favorite supermarkets. The nice attendant scans your item, and when they do that, they are updating data in a transaction processing system. Or you go to an ATM and you are withdrawing cash from the machine. You are dealing with a transaction processing system. Or you are buying books and other items, perhaps even electronics, from your own online bookstore that now has grown and sells more than books. Not just books, it sells other items as well. So that interface is between you and the transaction processing system. And so the TPS supports the daily business operations. And what that really means is that per day, there may be huge volumes of transactions that the system has to contend with. Going back to that example of your online retail retailer, they are selling books and computers, and so people across the globe, and so there are going to be perhaps millions of transactions per day that the system must be able to deal with. The other subsystems, your general ledger financial reporting system and your management reporting system, these we will talk about in some detail as we move along in the course. But the general ledger stroke financial reporting system, here you are talking about data that comes from what are called transaction processing cycles. We will be talking about these, I believe, from chapter 2. But the rest of the course really from chapter 4 to chapter 8 is about these cycles. So we'll talk about that a lot. And your MRS provides internal financial information needed to manage the business. So things like your budgets and your variance reports and stuff like that will come from your management reporting system, while your financial statement will come from your general ledger and financial reporting systems. But these are systems that this course is about, so we will talk about them quite a bit as we okay. And now here is what the book refers to as a general model for EIS. And that is the thing that you notice when you look at this diagram, and that actually is why my train of thought was involved. As soon as I looked at this, even though I was still thinking about the other thing, the thing that immediately jumped, you see, you looking at it, you immediately see that idea of a system. That if you look at this big box, you can think of this as a system that is taking in some input for data. It does something inside and produces outputs. And here is your feedback loop, right? So you can think of this as a black box. We don't know what is going on inside, but we know that something in the form of data goes in, and this huge black box does something to it to produce information that goes to external users, perhaps to your regulatory agencies, for instance. But then also we can take the lid off the black box, look inside and see what is inside. And when we do that, we see that inside there's a system. And what is the system? Well, the outer system we can think of as our organization, a system that exists inside some business environment. But when we go inside, now we're looking at another system. And this system is in fact our information system. And that information system, this is the blue part now. That information system takes in data, does some processing, and generates information that can go to external users as well as to internal users. And this blue system has a feedback loop that will influence what data is pushed into the system. The data comes from external sources as well as from internal sources. So you have internal sources of data and also you have external sources of data. So the two sources of data feed into this data collection mechanism, this input component of the system. And the data goes in, and because we are dealing with a lot of data, we need some way, some tool for effectively and efficiently managing that data. And for that, we use a database management system. Here, we may be thinking about something as simple as Microsoft Access, or maybe the bigger boys like Oracle and Microsoft SQL Server and things like that, or even the free things like open source tools like MySQL and Maria, which can handle huge volumes of data efficiently. So the critical thing here is we want to be able to store data so that when we need it for processing, we're able to quickly and hopefully painlessly retrieve it from our system. So we need an effective system for managing our data. And once we have done our processing, then we need some way of inputting that sort of outputting the results, the information, so that the end users, internally or externally, can consume that information. So this is a system that sits inside another system. The inside system is the information system, and the outside system is the organization. So it's actually quite a nice diagram. And this slide just talks about the data sources. Remember we said the external sources and the internal sources. So this slide is simply trying to say, okay, what are the data sources that we are talking about? Externally, we may be talking about ourselves, the firm, selling our goods and services to our customers. It may be ourselves buying inventory from our suppliers, or we are receiving cash, or we are disbursing cash, as in, for instance, when we are paying our employees. Internally, we may be thinking about the movement of raw materials across departmental boundaries, as the raw materials move perhaps from the warehouse to manufacturing, so from one department to another. That's a transaction that we need to capture and manage. Okay, now that diagram, remember, was a diagram of a system within another system. The information system as the inner system and the organization as the outer system. So for us to be able to implement and manage and benefits from information systems, we need to understand the context within which they exist. We need to understand the organization within which they exist. In this course, we will not spend much time doing that. We are going to assume that the other courses that you are taking will cover that in detail. But in passing, we know that organizations are organized. They are called that because they are organized in some way. And that organization, that structure, we can talk about the organization of an organization. So that organization helps the organization to allocate responsibility and authority and accountability. We know, for instance, what the accountant, the chief accountant, what their authority is, what their role is, and what we can hold them accountable for. But we know who is supposed to do what, whether we are talking about individuals, looking at their roles. If your role is that of chief information officer, then the responsibilities and attached to that particular role. But also we can think in terms of responsibilities being attached to departments. This department is responsible for that, and that department is responsible for something else. So that is what we mean by this idea of organization. It's not haphazard. The organization is organized. That is why it is called an organization. And one way of organizing an organization is by business function, where we say, okay, this is marketing, this is, actually we have it here. So here, here is where, we segmented by function. So now we have this organization, maybe it's some car manufacturing company, and here are the functional areas. So we are organizing by functional area. There's a unit, a division called materials management. There's a unit called accounting. There's a unit, and so we can assign responsibilities to the units. Accounting is responsible for blah blah blah. Marketing is responsible for blah. So we can do it that way. So in this case, we can see, for instance, that marketing is responsible for promotion and advertising and market research and sales, while distribution is responsible for warehousing and shipping. But you see, these also are units. So there's a division called distribution, and inside that division there are smaller divisions or units, one called warehousing and the other called shipping. So we can go inside and say, okay, these guys are responsible for warehousing, but what precisely do they do? These guys are responsible for shipping, but what precisely do they do? And if you look at the way this diagram is organized, you can impose your value chain on top of this diagram. That's when we are manufacturing whatever it is we're manufacturing, we need raw materials, and once we have them, then we can produce the products. We can manipulate the raw materials to produce the product. Now that we have it, we need to market it and to distribute it. And in producing it and marketing and distribute it, we do so through our personnel who need to pay. Then of course we need support services. So it's a nice diagram that you can start with and then impose your value chain model on top of this. Those of you that are familiar with the work of the likes of Porter and others. So that is one way in which you can organize or segment a business, and it's a particularly common one. But also you can segment in terms of geographic location or products. We were talking about business function. Product is where you say these guys are focused on, if you are a company like Microsoft, for instance, these guys are focused on the product that we call Windows, the operating system. These guys are focused on the product that we call Microsoft Office. These guys are focused on Microsoft Edge, the web browser. So in that case, you are organizing by products. But sometimes you can also organize by geographic location. I have a branch in Maung, and I have a branch in Francistown, and I have a branch in Mabani, and I have a branch in Nasir. Of course, there's nothing that stops you from combining all of these approaches. And in fact, particularly when you're thinking about large multinationals, they will be combining all of these approaches. So the basic idea behind organizing, behind segmenting, is that you want to promote internal efficiencies through specialization of labor. So your engineers are focused on what they are good at, what they've been trained to do, and your accountants are focused on what they are good at, what they've been trained to do. And so in terms of resource allocation, also there's clarity. Where should we acquire, for instance, more in terms of human resources, as an example. So that covers then the idea of organizing. And you need to understand this when you are building systems, because your systems do not exist in a vacuum. They exist in an environment that is governed effectively by the structure of the organization.